Hello, everybody, and welcome to the Like Totas channel. Happy Thursday to all of you, dear viewers. And I can't believe how fast this week has flown by. And here we are for yet another day in the stock market. And talk about volatility, everyone. I mean, the futures. I'm recording this on April the 2nd, and I will be posting this video today. And the futures are already pointing lower. We will talk about all that you need to know in the next few minutes. But today's video is going to be on Nike and whether I think this company presents a buying opportunity at these levels. Maybe some of you are already shareholders in the company. I certainly had the opportunity to analyze it when I was doing my due diligence on Lululemon, and I had to pick one because I run a concentrated portfolio. There is only so much customer discretionary exposure that I want to have. And but sure enough, while comparing Lululemon to its competitors, Nike as the biggest market share, as the biggest player in the market, of course, came on the radar, and I had to analyze them as well. Eventually, I decided to settle on Lululemon, and I'm very happy with my decision, needless to say. But anyway, let's talk about Nike and everything that you guys need to know. All right, guys. So they reported earnings yesterday. Was it yesterday? I think it was yesterday, and the stock got absolutely smoked. And you know, it's funny because they actually beat on earnings per share and revenues, but they missed their sales targets in the United States. And looks like analysts are paying close attention to the United States regional turnaround, right? This is what they are paying the most attention to. They want to see that the business can turn things around in the United States, and they actually missed by a penny, literally. But that was enough to crash the stock nearly 15%, which is staggering, considering that the business was already down over 60% from its all-time highs. But this is it, guys. So just because the business is cheap, it doesn't mean. And by the way, even though they crashed another 15%, in fact, even though the business was down 60% from its all-time highs, it was still expensive. So, for example, if you look at the price to earnings ratio at the time, in one of my past videos, I actually alluded to this, that, for example, the PE of Lululemon at the time was 10 times, and they were growing revenues. The business was not contracting. It was slowing, but wasn't contracting. Nike was a completely different thing. So the business was declining. The revenues were coming down together with profit margins, and profitability was taking a big hit, right? The returns on capital had plummeted as well. And yet the business was trading around 30 times in the lead up to the earnings call, which is staggering. But anyway, so yes, let's talk. You can see right here, this is exactly what happened. Nike sank even after topping earnings and revenue forecasts, as North American sales narrowly missed expectations and guidance stayed cloudy. Typically, what will really crash the stock is not so much the fact that they miss projections. It has more to do with guidance, right? What are they guiding for? And you can see that guidance stayed cloudy. If there is one thing the markets hate, is uncertainty, and that seems to be casting a lot of doubts on the company's turnaround, which is why we see the stock under pressure. Management sees sales down 2% to 4% next quarter. China is down 20%. This is staggering considering how fast Lululemon, for example, for comparison, has been growing in this market, and turnaround stretching into 2027. And then what happened was a sea of downgrades in typical fashion, because they always love downgrading in the how can I say, when the stocks are near all-time lows. Downgrades from JP Morgan, Bank of America, and Goldman Sachs added pressure as patience is wearing thin. Right, and right here, as you can see, if I go right here to Nike, let's see if we can find that. Where is Nike? Let me just minimize this. You can see Nike right here Yeah, it crashed 15.51%. Look at that. This is a staggering 75% crash from its all-time lows, guys. I mean, so without counting dividends, of course, you haven't made any money since 2015. In fact, if you invested in the stock in 2015 without counting for dividends, because they pay dividends, but you saw no capital appreciation, which is staggering. There's a lot of damage right here, but I'm not new to this because I typically like to invest in companies that are collapsing, as you guys know, and that means erasing several years, maybe a decade worth of shareholder returns, which is staggering. All right, so very nasty these charts, if you ask me. But anyway, it looks like the turnaround is going to take longer than anticipated, and but now, do I think Nike is a good investment at current levels? So that is the point. And I'm going to show you a few things right here, guys. So let's look to our stock analysis in stock unlock, and I will tell you exactly why I would stay away from this company. All right, let's go here, Nike, and now we will go right here. This is taking a little longer. Okay, so let's have a look. Nike. Here we are. Right. So what we can see right here, number one, I'm going to show you exactly what I meant by the business being contracting. If you look at total revenue, this is what's happening, guys. Okay, so you can see that total revenue, which has compounded by about 6% since 2011. Look what happened since this peak right here in 2024. And if we zoom in on this, you can see that revenues are actually, I mean, granted, they seem to be recovering slightly on a quarterly basis, which is good. That is the first sign that you want to look for that you want to look for a turnaround. The trailing 12 months, of course, you can see that the revenues are still down from the peak, and the business since then has been contracting. Because if I show you this right here, since 2023, revenues have declined by about 3.77%. So this is what I mean when I said the business has been contracting. Okay, and this is in stark contrast to what's happening with Lululemon, for example. But if I show you right here now operating income, you can see how, I mean, look at the significant decline. And this is on a trailing 12-month basis. Since 2023, income from operations declined by 23%, which is staggering. Let's zoom in on this. And on a quarterly basis, you can see that there have been significant improvements from these lows reached in Q2 2025. So this is something that I like to see as well. But what you can see going right here on a quarter is that, exactly, so operating expenses continue to go up, right? Certainly, they have remained much higher relative to total revenue as a percentage of total revenues, which has caused operating margins to actually come under pressure. And if I show you that right here, if we go immediately to metrics, and if we go here to operating margin, you can see that on a trailing 12-month basis, operating margins have been declining substantially. Now, granted, they have slightly, in fact, they have improved substantially since the lows in Q2 2025. And if we go right here to net margins, you can see that paints a similar story. Tells a similar story, which is good. But on a trailing 12 months, you can see how drastic that collapse was. I mean, this is staggering, right? This is absolutely staggering. And so in the free cash flow margin is more of the same. Let's see if it's improving on a quarterly basis. Probably the business has been doing a lot of reinvestments to remain competitive because they have to defend the market share. right? They have to do that. So I assume they are probably cost conscious as well, while not sacrificing a lot of investments. If we go here to investments in plant, property, equipment, so CapEx, you can see that they have been ramping up CapEx since since May, 2025, as you can see right here, on a trailing 12-month basis. So yeah, you can see again that we are at the highest level since 2025, right here. So February 2025, and near the same levels as in November 2024. So they are spending. And if we go right here to the income statement and see the operating expenses around R&D, not sure if that will show up here. Maybe we'd have to go to the annual reports. No, selling. Yes, so we have SG&A, which is also very good. Yeah, this is good. This is what I mean. So yeah, so they've remained pretty flat, but because revenues have come under pressure, the percentage of SG&A relative to total revenues is going up. Okay, which is adding further downward pressure to these margins. So this is what we are seeing. It's nice to see that the company has been improving slightly on a quarterly basis. I like to see that because that is the first hint of a turnaround. But look, it's just too early to tell. If you believe, and a lot of this story is going to come down to the consumer, and that is another thing that I want to call that I want to draw your attention to. So, guys, I have this right here, and I'm going to show you this. This is absolutely mental. I mean, take a look at this. University of Michigan consumer sentiment. What you can see right here is that consumer sentiment is. I mean, you would have to go back to. You would have to go back. It's even lower than it was back in the 2000. Right, so it's even lower than it was back in the 2008 global financial crisis, and you would have to go back to the early 80s to see consumer sentiment at these low levels. And you had similar stuff happening right here in COVID. I mean, you really can't make this up. So look, I believe that the entire consumer discretionary segment is bound for a staggering recovery rally. All right. Now, what that means is that because I believe that's going to be the case, I think that these companies, and Nike certainly probably because they have the largest market share, of course, and they are still number one in this sector. Right, as far as excuse me, so yeah, as far as shoes is concerned, that's what they do. They are a retailer, right? And so they are poised for a significant rebound. In look, the only reason I didn't pull the trigger on Nike once again was because I just found Lululemon to be a lot better positioned. Number one, Nike is already a behemoth. They are already all over the world. It's very hard for them to actually compound shareholder value at significant returns going forward, because there is only so much that the company can grow. Now, granted, if the company turns around because the stock is down 75%, you can get a quick double or triple on your money in a short period of time. But this is what distinguishes me from core value investors. I'm also thinking a few years out. Ideally, I like to buy a company with plenty of reinvestments and growth opportunities. Right, and Lululemon is only in the first innings of its international expansion, and so I think the story is a lot more compelling in comparison with Nike's. But that's just my personal opinion. But this is incredible. So this is the time that we should be buying consumer discretionary stocks hand over fist, because they typically recover the strongest after consumer sentiment moves back up. So if you believe that consumer sentiment is going to come back, is going to see further declines in the months and years ahead, then it stands to reason that many of these stocks will continue to see selling pressure. But I cannot predict the markets. I can only look at the company's fundamentals and determine very simply if I'm having a if I'm getting good value for my money. That's it. There is only so much that we can control, and macro aspects are certainly not one of them. So buy not because you think there will be a recession or consumer discretionary will continue to collapse, but rather because you believe the underlying fundamentals of the business are improving, and you believe you are making a good investment. And so I showed you a few things here with Nike. What would be interesting is if we go right here to the Insiders tab, you can see that there has been some selling pressure, but nothing really nothing alarming. You can see there was buying pressure as well. You look, some buying. Even Elliott, the president, CEO, and director, was buying shares in December 2025, which is good to see. And Tim Cook as well was also buying shares because he's an independent director. So this suggests that they are bullish on the company. Again, there is only so there can be many reasons why management team will sell, but only one reason why they would buy, because they think the stock is going to end up higher over time. And but yeah, what I see right here, guys, is a company that is struggling to turn around. And I will show you, for example, I will compare this with Lululemon. Okay, I want you guys to see some cool stuff. So if I go right here to Lululemon, hold on, it's taking a while to open. And as we wait for this to open, let's go here to stock analysis, because I want you guys to see something. Okay, so this is what I wanted to show you. And what we can, by the way, just take a look at this. So the PE is at around 29 times. Even though the stock has plummeted, the PE is still at 29 times. And on a forward PE, it's around 27 times earnings. I mean, this is, and look, you can look at every measure that you want, but Nike is certainly not cheap. Let's put it that way. So what you see is that because earnings have come down substantially, even though the stock has plummeted like 75% from its all-time highs, the stock is still expensive because you have to account for that decline in earnings. And it's like the stock hasn't come down low enough. Okay, but you can see that analysts still rated a buy. All right, not a strong buy, a buy, but that is important to address. And if we look at the consumer discretionary sector on the whole, you can see that the PE ratio for the sector is around 37 times. So Nike is definitely cheaper relative to the entire sector. But don't forget that you have a business that is still declining, that is contracting. It seems to be rebounding a bit on a quarterly basis. But let's have a look at something here. So let's change this to quarterly. Okay, and now you can see here revenues. Yeah, because these ones update faster. The company reported they reported earnings in stock analysis. So they reported earnings yesterday. In stock analysis does update this faster. So I think this one is more accurate than stock analysis. But you can see right on a quarterly basis. Look at this. So already contracting relative to the same quarter, relative to the same to the previous quarter. And same thing if we go right here to operating income. Take a look at this. All right. So this is not what you want to see, guys. Free cash flow is significantly down as well, but this is because of reinvestments that can yield returns into the future. So I'm not putting too much emphasis on that. But look at net income. So what you can see that is that, like, if you really zoom out over the last 5 years, this has been the quarterly performance for Nike in terms of earnings. Net income under pressure here, guys. Okay, so it's definitely collapsing. And if we look at the ratios, for example, the returns on capital, look at that. They are all trading lower. I mean, take a look at Royce. Look at Royce. Makes sense because profitability is getting hit sharply. Okay, so and this is on a quarterly basis, by the way. This is on a quarterly basis, so not good to see. at all. In addition, if we go, let's go here to the statistics tab and see what we have. And see what we have. So you can see that debt to EBITDA is still healthy under 3, which is good. Debt to free cash flow is NEA because net free cash flow is negatives. Yeah, so it makes sense to be not applicable. But yeah, look, I mean, look at this. So Royce is about 12.77%, while the cost of capital is about 10.14%, which means you have about a 2% economic spread. All right, this is certainly not what you want to see. So definitely the company is not creating any value for the shareholders, if any. So it's creating just a bit of value for shareholders, but nothing to get excited about. And yeah, so the shareholder yield sits at 4.86%, which is higher than inflation, but it's not reason to be very excited, if you ask me. And if we also look, I wanted to have a look at Lululemon, and I'm going to show you exactly why I prefer Lululemon over a company like Nike. Okay, so let's have a look at this. Lululemon, come on, come on. Why is this taking a while? Right here. Okay, cool. So Lululemon, yes. If we go here, I'm. Let's have a look at the quarterly performance as well, and let's compare the two of them. My internet must be a bit sluggish, so bear with me. Can I see that? Yeah, so this is the 5 year. This is on an annual basis. Look at that. You see? So on an annual basis, unlike Nike, Lululemon never stopped increasing its revenues. So the business was expanding, not contracting. And if we look at the quarterly revenues, take a look at this. So on a quarterly basis, this was look at that. Since 2000, these were the highest quarter so they this the last quarter marked the highest quarter by revenue going back at least to 2020 to January 30, 2022. Okay, so this is very good. In addition, if we look at the operating income, take a look at that. It took a hit because of tariffs, but because Lululemon already boosted higher margins compared to Nike, they can absorb a lot of those additional costs without sacrificing a lot of the business quality. That's what I mean. That's what I want to say. And so, yes, so you can see that even despite these tariffs headwinds, they still clocked in pretty solid operating income last quarter. And if you go right here to the pre-tax income, is more of the same. And if you look at the earnings per share diluted, now let's look at net income because we don't want to account for any buybacks. Take a look at that. Not bad at all, guys. This is completely different from what we are seeing with Nike, right? In addition, if we go right here to, I don't want to see the cash flow statement. I actually want to see the ratios tab. So let's see if this opens because I want to show you guys the returns on capital. Yeah, if this does decide to open, come on. Yeah. In addition, I want you guys to look at margins as well because that's important. Come on. Why is this taking so long to open? Crazy. Right. So ratios. Let's see. Let's change this to the trailing 12 months. And is this, yeah, so it was quarterly. Right. So on a quarterly basis, you can see, look, this is where we are in terms of even ROIs. This is where we are. Okay. So it's significantly lower compared to the same quarter last year because of all the tariffs. But you can still see that even against that backdrop, things remain fairly compelling for this company from a financial standpoint, certainly relative to Nike. And if we go right here to the debt levels, are we still in quarter? Okay. So what else did I wanted to show you? Yeah, look, the P ratio, right? So 11.98 versus almost 30 times for Nike. Now I'm looking at the trailing 12 months. Look at the forward P, right? So it's about 12.89. And you can see that the P ratio right now is 11.98, so call it 12. So what you see right here, everyone, just to wrap up this video, is that you see a company that is fundamentally stronger, so a company whose business, the core underlying business, hasn't taken as big a hit compared to Nike, and yet you see a company that is priced much cheaper compared to Nike. Now you can say, "Oh yes, but Nike has such a wide moat compared to Lululemon." Yes, but the business is deteriorating staggeringly. I mean, and that's it, right? The white moat is good, but number one, Lululemon also has a moat. And number two, it's not just because the company has a wide moat, it doesn't mean that that moat cannot be disrupted. And certainly, the company is struggling at the moment, and I do believe that Lululemon is in a much better position, and it's attract more cheaply. So I believe in comparison, I can get a much better return on my investments in the years ahead. Okay. Right, guys, sorry for the rant, but hopefully you managed to understand a bit more about my reasoning and why I'm not pulling the trigger on a company like Nike. However, I want to make this point clear. Consumer sentiment is very, very low at multi-year lows. And once consumer sentiment rebounds, and I think we are primed for a sharp rebound, you're going to see these companies exploding. And the reason for that is uh, look, sooner or later, consumers will start spending again. And these companies are going to be major beneficiaries. Every single time in history that consumer sentiment was at these lows, you saw in the subsequent few years a staggering recovery. I don't think this is going to be an exception. Can it go lower a bit more? Yeah, sure. But what you guys should be doing right now is planting the seeds for that next rebound, and that's precisely what I'm doing with my money. And hopefully you manage to learn something from this as well. So you guys, if you like this video, please smash the like button, and because that really helps the channel. And don't forget to share this the channel and in videos like this to people who are also passionate about the markets and want to learn this stuff. Thank you, everyone. Stay tuned for more.